Hey everyone, my name is Kyle Frizzell and I am one of the attorneys with NC Planning, joined today by one of our partners, Lauren Maxey. Together, we're excited to welcome you to an extended tax talk about some of the possible tax changes that we may see as a result of the 2020 election. Now, I say extended tax talk because if you didn't know, we have a series called Tax Talk Tuesday on YouTube that we regularly update. So if you've seen it, really appreciate you taking the time to watch it. And if you haven't seen it, you're really missing out on some good information. If it helps you at all, you can totally let those videos play in the background so you don't have to look at me all that much. Uh, but this video today is really going to focus on changes that we could see in light of Joe Biden winning the election. We're going to have another video later on where we're going to discuss some potential planning strategies that may make sense in the future. But as crazy as it sounds, this whole thing is really going to come down to what happens in the great state of Georgia. Right now, there's two Senate seats that are up in the air. And if one of those seats goes red, so to speak, these changes are much less likely to occur. But if both of these seats happen to go blue, we're probably going to see legislation dealing with some of the changes we're going to talk about today in very short order. So today we do want to focus on some individual income tax changes. I'll be discussing those. Lauren's going to talk to you a little bit about business tax changes that are heading our way, and also the estate and gift tax. There's some changes that may be in the hopper, we want to say that, may be heading our way on that front too. But without any further ado, I did want to start with the proposed changes to individual income tax. And I guess if we were going to summarize this, sum it all up, probably the biggest thing that you'll want to take away here is that if you're a high income earner, your taxes are probably going up. So right now, the Joe Biden tax proposal currently says that if you are making over $400,000 a year, which is a lot of money, they are looking at basically rolling back the changes that were made in 2017. So back in 2017, we were given the Tax Cuts and Jobs Act, which increased taxes or lowered taxes kind of across the board. Here, we're looking at kind of a reversion for high income earners. So that if you're making over $400,000, things would go back to the pre-Tax Cuts and Jobs Act tax rate of 39.6%. So that's right now it's 37%. So we're looking at about a 2.6% increase in that tax bracket. But that's really not all. There's also right now, you pay Social Security tax, payroll tax on certain income that you may have. Basically, the Biden tax proposal would impose that Social Security payroll tax again on income earned above $400,000. It's a 12.4% tax. It's split evenly between employers and employees. And what this is going to do is it's going to create some kind of a donut hole where you'll pay Social Security payroll tax on income up to a certain amount. There will be an untaxed, or I don't want to say untaxed, but there will be no Social Security payroll tax paid on an amount from, right now it'd be $137,700 all the way up to $400,000. And then that Social Security payroll tax is going to kick back in for income over and above $400,000. So again, another big change there, taxing high earners. A change that Lauren's probably going to touch on a little bit more later on, but I do want to at least raise it because it does impact individuals, is a change to tax long-term capital gains, which currently have their own tax rate, changing that to being taxed as ordinary income, but only for amounts over $1 million. So that sounds like a lot of money, and it is a lot of money. But if there is family land that gets sold for a large amount, or if there's a business sale that occurs, and the proceeds of that sale are over and above $1 million, we're looking at long-term capital gains being taxed as ordinary income. So instead of it being somewhere 20% or so, wherever it is now, we're looking at a long-term capital gains rate of 39.6%, the same as the ordinary income tax rate. So again, high earners or for large sales, we're looking at an increase in taxes there. I guess we'll call it the third big change for high earners earning more than $400,000 is there would also be a cap on itemized deductions, whereas right now that there's certain things that are capped and certain qualifications that you have to hit, but now it would just be kind of a blanket cap on itemized deductions once you reach a certain level of income. There's also something called the PEAS limitation. There is a chance that this PEAS limitation gets restored, which is going to act to actually, rather than being just a cap on itemized deductions, the PEAS limitation actually reduces your itemized deductions if you are, I don't know, we can say making too much money. I don't know if that's a thing, but that's kind of the idea. This was named after a former congressman, but basically it would reduce taxpayers' itemized deductions by 3% for every dollar of taxable income that's above a certain threshold. If it's going to be that $400,000, which it looks like, it's just something to be incredibly aware of. Again, that $400,000 income number is incredibly important, again, because back in 2017, you may remember all the talk and buzz about the qualified business income deduction, which was a 20% reduction in certain qualified income. The Biden tax proposal would get rid of that qualified business income deduction. It's Section 199A. But getting rid of that for taxpayers who are making more than $400,000. So I know just from our perspective, we've done a lot of planning around this QBI deduction over the last few years. And all of that's probably going to need to be revisited depending on income levels of various clients. So I guess to sum up these changes on the individual income tax side, high earners or large proceeds events like big sales of land, of commercial real estate, of business that you may own. All these things are looking at being taxed at a higher rate. And in some cases, especially on the capital gain side, a tremendously higher rate. So definitely want to be aware of those. Again, we don't know the likelihood of these changes. But hey, a lot's going to hang in the balance on what happens in Georgia. Did want to take a minute to hit on a couple of other things because I feel like I've just been saying things that sound bad. There are some changes that may be beneficial to various, basically various taxpayers depending on their circumstances. There's what's called the Child and Dependent Care Tax Credit. That is going to be increased basically from where it is right now at $3,000 to an amount up to $8,000 or even $16,000 for multiple dependents. Good time here to touch on kind of the difference between a credit and a deduction. This is a tax credit, meaning we look at your tax bill and we reduce it by the amount of the credit. This is different than a tax deduction, which looks at your taxable income, reduces the taxable income, and then calculates the tax. So I guess the bottom line here is you get a dollar for dollar reduction in your taxes when there's a credit applied. And a credit can push you into a potential refund or can potentially eliminate certain tax. So for individuals who are taking care of children, taking care of other dependents, this could be a tremendous benefit for you because it does have a maximum of $16,000 worth of a tax credit sitting there. In addition to that, there is the child tax credit, which is different. Right now, there is a maximum value of $2,000 for each qualifying child. That's a child under 17. That amount under the Biden tax proposal would go from $2,000 to $3,000. So a little bit more money there, a little bit higher credit. But I guess the additional benefit here is that if you have a child under the age of 6, we're actually going to see a $600 bonus credit for each child under the age of 6. So this credit can really add up depending on the number of children you have. And it's something that your tax preparers, everybody wants to be aware of when they're plugging all these numbers in. A couple other credits that I just wanted to hit on really quickly. The Biden tax proposal does reintroduce the first-time home buyers tax credit. This was originally around back in the time of the Great Recession. It was designed to help the housing market when everything kind of went south back in 2008. Biden's home buyers tax credit would be a maximum amount of up to $15,000. So if you're buying a house for the first time and this changes in place, that's a credit that you have to factor in. Another one is the Affordable Care Act premium tax credit. The big idea here is trying to make health insurance more affordable. Depending on different qualifications, you may be entitled to a credit based on the premium that you're paying under the Affordable Care Act. And then last but not least, and this one's one that I don't know a whole lot about yet. There's probably more to come. But there's what's called a refundable renter's tax credit that's capped at $5 billion a year. That's really all we know about it. And what the goal of this is if you're a renter, not a home owner, is to try and help steady rent and utility payments and keeping them under or at about 30% of monthly income. As I think it's becoming common knowledge, the rental rates are increasing at really a high level right now. But a lot of people can't seem to get out of and they may not have a desire to own a home, but a lot of people really don't have the resources to buy a home. So this is designed to help them out a little bit too. So those are kind of just some big ticket items on the individual income tax side. I guess the bottom line here, if you're a high earner, expect to pay a little bit more taxes if these tax changes come through. And so without any further ado, I will turn it over to Lauren, but I don't know, Lauren, do you have anything that you want to add on the individual side?
Yeah, and thank you, Kyle. Thank you for all of that. Certainly just echoing your sentiments of this is all theoretical at this point in time. We're closely watching what happens in Georgia. Certainly this is what Biden has rolled out as his proposed tax plan. As everyone knows, things tend to get negotiated. And with the voting threshold that we're looking at, if both of those seats in Georgia go blue, we will still have to have essentially all of the Democrats in line to vote and approve of this plan. So if one Democratic senator has an agenda where they want to tweak one of these things to make it more beneficial to their state's population, there's definitely going to be some potential negotiations occurring to get this through, but this is generally what we're looking at. You're absolutely right, Kyle. The changes in how some of that business income is going to be treated for the QBI deduction, that's huge. A lot of people were really enjoying that tax deduction. Additionally, as you touched on with the treatment of income above that $1 million threshold as ordinary income rather than potential long-term capital gains, that's a huge change as well for those that are looking at selling their business. And so it's really about being proactive with our planning, as we always talk about with clients. It's not necessarily letting the tax tail wag the dog, but let's plan accordingly and know what we're looking at there. So to kind of dive right into some of the other business tax changes, again, some of these are big changes that are going to impact a lot of individuals. Other tax law changes here are more so aimed at those multi-international corporations and just not going to impact our day-to-day clients as much, but we'll kind of walk through them piece by piece. So first and foremost, and one of the biggest changes Back in 2017 with the Tax Cut and Jobs Act, we reduced the corporate income tax rate from 35% to 21%. Biden is proposing to change that from 21 to 28%. So not quite where we were pre-2017, but still a significant increase there to be aware of for the corporate income tax rate. Number two is looking at creating a minimum tax on corporations that their book profits, what they're showing on the books, is over $100 million. So again, most of our clients aren't going to be looking at this, but those big corporations, if they're over $100 million in essentially profits on their books, the minimum tax is going to be 15%, and it's kind of an alternative minimum tax. It's going to be the greater of essentially their corporate income tax rate or this minimum tax rate. And what that's getting at is you hear a lot about these huge corporations that effectively don't pay taxes. This is kind of targeting to that. We'll still be allowing for net operating losses and foreign tax credits and things like that, but trying to have a minimum tax rate there. So that's number two. Number three is something we're going to be talking a bit more about with our clients because it's proposing of offering tax credits to small business owners for adopting workplace retirement saving plans. So whether it's a 401k or simple IRA that we're looking at, those types of structures that may have been potentially cost prohibitive in the past for some of our clients with these potential tax credits, and we'll see what we're looking at on figures, but this is something we're going to be keeping a close look on for our clients. The fourth thing to touch on, again, given the climate change initiatives that the Biden administration is getting behind, that's working its way into some of these tax changes as well. So they're expanding several renewable energy tax related items. So tax credits for carbon capture and use and storage and things like that. Restoration of energy and investment tax credits and the electric vehicle tax credit. So if any of our clients have big vehicle fleets or something like that, we're looking at that. And it's also proposing an end on the tax subsidies for fossil fuels. So again, just trying to kind of incentivize certain behaviors through tax credits and those items. The last two items, again, not terribly applicable for most of our clients, but worth mentioning. They are looking at imposing a 10% surtax on corporations that offshore manufacturing jobs or service jobs, and then trying to sell it back in the American market. They're trying to, of course, discourage that behavior. So there's that 10% surtax that's going to apply there. That's essentially going to effectively raise the income tax rate on those types of activities to 30.8%. So a very significant change there. Last but not least, they're looking at establishing a 10% quote unquote made in America tax credit to restore production if revitalizing existing closed or closing facilities, retooling facilities to advance manufacturing and things like that. Again, we'll see what characteristics and what kind of guidelines are given of when you can take this tax credit and how much it's going to be looking like. But that's kind of the thing. They're kind of thinking 10% at this point, but how you qualify and when you qualify, we'll see. That's a little bit on the business side. Again, the primary thing being they're looking at those big corporations and trying to incentivize people to keep things here in the US and taxing those bigger entities. The main thing for our clients is, again, that increase in the corporate income tax rate to 28%. So let's turn our focus now to the estate and gift tax realm. This is what we spend a lot of time talking with our clients about as well. And these are incredibly significant changes coming down the pipe. So we definitely want to be looking at this. It's all, again, theoretical at this point, but as many of you are aware, right now, essentially, an individual can give away 11.58 million during their life or at their passing. So that's gifting or estate bequest, give away $11.5 million per individual without incurring a gift or estate tax. And you double that essentially to $23.16 million per marital couple. So most of our clients have not really had estate and gift tax concerns since the Tax Cut and Jobs Act came into play. Biden is potentially going to change that significantly. So changing our exemption amounts for estate tax, we're looking at potentially reducing that to $3.5 million per individual or $7 million per marital couple. The gift tax exemption is looking at getting reduced to $1 million per individual or $2 million per marital couple. So again, a significant change for those that maybe have a family-owned business, have some land in the family that they're upwards of $7-8 million. The example we wanted to share, kind of working with easy numbers, is say you've got a family-owned business roughly valued at $11 million. Right now, you can give that to the next generation without incurring any estate or gift tax. You certainly have to report that you use that lifetime exemption amount, but no real taxes due, assuming you haven't made prior taxes in your lifetime or prior gifts in your lifetime. So right now, could give that away. Once these changes come into effect and that $1 million exemption is only allowed for gifts, you're essentially paying tax on the remaining $10 million of a gift that you're making there. And the kicker is they're looking at increasing the rate to 45% from that 40 or 39.5% roughly. So with that gift of that essentially excess $10 million that you're giving, you're looking at paying $4.5 million in taxes on that transfer. Again, these are some significant changes that we need to be keeping an eye on. Our whole next video is going to be talking about solutions for these issues. So there are tools in the toolbox on how to minimize some of those taxes and what we want to be proactively looking at with our clients, but the essentially reduction in those exemption amounts for estate and gift taxes and the increase in the tax rate to 45%, huge changes. The other big change that we're looking at is they are discussing eliminating the step up in basis at death. So what that means, and as many of you are aware, say you buy a piece of stock for $25,000 or some stock for $25,000. Ideally, the market does well and it increases over time in value to say $200,000. Right now, if you hold on to that stock and give it to your children at your passing through your estate plan, essentially they get a step up in tax basis to the fair market value as of the date of your passing, and theoretically could sell the next day for little to no gain at all. That is potentially going to go away. And so what they're looking at is if you give it to your children at your passing, the tax basis transfers and they have that $25,000 tax basis, they go to sell, they pay tax on that gain, or potentially your estate is going to pay tax. And so when that tax is due is the other big issue they're looking at. Potentially, they're looking at it being due upon your death, being that the quote unquote realization event upon your death is when that tax is owed, because that's kind of a transfer they're saying to the next generation. The other option is kind of just transferring the tax basis to that next generation and having the tax due upon sale at that next generation when they eventually sell it. So a lot up in the air, but this is a significant change as well, in particular for those that own a bunch of stocks or same thing with land. If we have some family land that's been in the family for say dad bought some land when he was younger and it's appreciated greatly in value, many individuals have been holding on to their land and planning on this step up in basis to their kids at their passing. So we need to kind of reevaluate our plans, look at what is the most strategic way of minimizing on these taxes that are potentially due. Again, lots of tools in the toolbox. It's just something to be proactive about. And so that's kind of, I suppose, where we'll close this tax talk. I know it's been a lot to take in. But don't get too overwhelmed with all of this. There are actionable items we can assist with. Again, we're going to be having it's a whole nother discussion on some of the tools in the toolbox. The biggest thing we stress is start having these conversations with your advisory team sooner rather than later. For those of you that kind of went through the fiscal cliff of 2012, that was a crazy time in planning. We want to avoid stress with this transition and just be proactive in our planning. So begin those conversations now, or if you know someone that this might impact as well, share these videos. Knowledge is power with this stuff, and we're big proponents of opening up those communications as soon as possible. I suppose that's it for today, unless Kyle, did you have anything else to add, dear sir?
Not a whole lot. Just really wanted to say, I think, Lauren, you're exactly right. I mean, it's all about being proactive, right? There's going to be a whole lot of changes, and there's not going to be a one size fits all type solution for this. It's going to depend on who's walking in the door, what your goals are. I think just kind of to sum up, these changes do impact high earners and they impact high net worth individuals a lot more. But I think it's important to remember too, I think with Lauren, you mentioned the family land side of things. Just because there's land and there's a sale doesn't necessarily mean there's always a whole bunch of other liquidity out there. So it is all about planning ahead, being sure, knowing what the next step is, and talking to your advisors early on. And I guess the only other thing we can really say is keep an eye on what happened in Georgia. You might not think it matters, but it really does matter this time.
Absolutely, absolutely. And thanks again, y'all, for taking the time today to tune in and watch this extended tax talk. And we'll be back next time with some solutions and tools in the toolbox for you. Thanks so much.